In our previous lecture, we discussed an accounting cycle, and we actually completed the whole accounting cycle, and we had covered all the major steps for completing accounting process. Uh, in the last class, we worked on financial statements, but none of the student asked that when do we make these statements. Um, Let me tell you, it depends on business. Some businesses prepare these financial statements monthly, some prepare quarterly, and some prepare annually. It depends on the business actually, and it depends when does a business want to transfer the information to the shareholders and other parties. So basically, but each and every company makes an annual report and they make annual financial statements and they do publish them. This 12-month accounting period is actually known as a financial year or fiscal year. Let's move on to next topic, which is adjusting entries. Um, there are four major types of adjusting entries. As you can see here, the four major types are prepaid expense, unearned revenue, accrued expense, and accrued revenue. We are going to discuss these entries one by one. I have made a table here, and you can see in this table we have nature of each type, relationship between accounts, what will be the originating entries, what will be the adjusting entries, and what will be the entry at the time of payment or receipt. So remember, adjusting entries are this one. The other two are originating entry or the entries at the time of payment or receipt. You will get an idea what is originating, what is adjusting, and what is at the time of payment or receipt once we start our lecture. Uh, Before starting with this lecture, first you should know what are adjusting entries, what are the characteristics of adjusting entry, why do we need to adjust, what are the principles on which the adjusting entries are based. First, we will talk about the principles on which adjusting entries are based. The first principle is realization principle. What is this realization principle? Realization principle is actually related to the revenue recognition. That when to record revenue, when to recognize a revenue. The realization principle indicates that revenue should be recognized at the time goods are sold or services are rendered. Kindly focus on the words. As I always say, focus on the words. Revenue recognition principle states that revenue should be recognized at the time when the goods are sold or services are rendered, regardless of cash movement. Why is it so? The reason is whenever your earning process means revenue recognition process or sales process or service rendering process has been completed, you can easily measure the value of the sales of goods or services objectively. When you can measure objectively, it means you can easily recognize your revenue. So remember, revenue recognition principle is all about whenever the products have been sold or services have been rendered, then a company can recognize its revenue. Recognition means actually you can easily record your revenue. As you all know, what is revenue? Revenue is whatever the price a business gets after selling a product or after rendering a service during a given accounting period. And as we discussed in our previous classes, that revenue is a component of owner's equity, is a building block of owner's equity. And how does a revenue affect on an owner's equity? Whenever revenue increases, it increases the owner's equity as well. And against the revenue, there can be only two things that a business receives. One is cash, and second is receivable. Um, while working on journal entries, I told you whenever you sell a product or provide a service, uh, against selling a product or against providing a service, you are going to receive a payment. And there can be two modes of the payment. One is cash, and second is receivable. There is an example. Uh, there is a marketing agency who contracts with business for airing their ads related to their products in August. And marketing agency successfully aired all the ads of that company in August. But marketing agency does not receive the payment till September. Now, when this marketing agency is going to recognize its revenue, would it be August or September? The answer is August. Why? Because I told you the revenue recognition principle says when the product is sold or services are rendered, a company can recognize or realize this revenue regardless of the cash movement. So remember, focus on the words regardless of the cash movement. In this example, we said marketing agency provided services to another company in August, and the payment is going to be received in September. But since marketing agency has already rendered the service regardless of the cash movement, then that marketing agency is going to recognize its revenue in August. The second principle of the suggesting entries is matching principle, or also known as expense recognition principle. This principle says that a company should record its expenses in the same accounting period as the revenues that are earned as a result of those expenses. What are expenses? We discussed in our class that expenses are the expenditures that a business incurs for the operational activities of a business. So, expenses are actually the cost of running a business or cost of operating a business. Why do a company spends on these expenses? A company spends because a company wants to earn some revenue. So there is a significant relationship between revenue and expenses. Why why a company incurs an expense? It incurs for the purpose of producing a revenue. For example, let's talk about research and development expense. In 2019, a company heavily uh, spent on research and development. Due to that research and development, their sales increased by 25% in the same year in 2019. And when we look at the previous year, the sales was not up to the mark because there was no expenditure on research and development. But when in 2019 the company spent on research and development, their sales increased. Now, matching principle says that your sales in 2019 increased because of the research and development expense that you incurred in 2019. So you have to match your research and development expense of 2019 with the revenue that you have generated in 2019. And remember, when the expense is incurred, you have to record it as an expense. Let me share an example with you. Just assume that there is a marketing team in a company for serving the customers. The marketing team served the customers in the period of July, but the marketing team has not received their salaries until August. So, in which month should these salaries be regarded as an expense? Would it be July or August? Let me tell you. The answer is July. Why? Because July was the month in which the marketing team provided its services to the customers to help the company in producing a revenue, not August. So, this is the reason we are going to record salary as an expense in the month of June. After principles, let's discuss about some characteristics of adjusting entries. First is that every adjusting entry involves the recognition of either revenue or expense. Revenue and expense represents changes in owner's equity. However, owner's equity is not changing by itself. There must be some corresponding change in either assets or liabilities. For example, if we say that a company has earned revenue, so that revenue will come in a form of either cash or a receivable. It means we can see whenever revenue is increasing, there is a change in owner's equity as well. But besides owner equity, there is a change in a corresponding account as well, which is a cash or receivable, and they both are the assets accounts. In short, it means every adjusting entry is going to affect income statement as well as balance sheet accounts. Second is that there is no transaction of cash while making adjustments. So it means in adjusting entry, there will be no involvement of cash. Third, adjusting entries are based on the concept of accrual accounting. Now let's discuss what is accrual accounting. So basically, there are two kinds of accounting. First is cash basis and second is accrual basis. As per GAAP and IFRS, a company is only allowed to follow accrual accounting, not cash based. The only difference is आप नाम से ही judge कर सकते हैं कि cash. So accrual accounting is actually that revenue is recognized when earned and expense is recognized when incurred, regardless of the cash movement. Whereas cash basis accounting say that revenue is both revenue and expenses are recognized when there is a movement of cash. So ऐसा हो नहीं सकता actually. ऐसा हो क्यों नहीं सकता? अगेन आप एग्जाम्पल ले लें कि जी